this is an ugly market. What I think is going on here is there are two factors for the market to digest. One is inflation, and that created the market to set up in certain ways. You know, everyone's crowded into certain themes. Then growth starts evaporating. You can see it all over the place, stuff like consumer discretionary stocks. You can see it in the forward-looking indicators. And so the market has to deal with inflation plus growth. And what that's basically mean is everyone's hit the liquidate button. So everything's getting liquidated. This is the correlation of one style markets that I was warning about. And it hits everything from crypto to, you know, pretty much everything. And the thing that stands above all ends up being the dollar.
Macroeconomic expert Raoul Pal says global markets are locked in a mass liquidation phase, and he doesn't expect a turnaround in the short term. In a new interview on Real Vision, Pal says no matter what's in your portfolio, more pain is likely in store. There is only one way out of the inflation problem in the US, and it isn't going to be a soft landing. With inflation surging to a new 40-year high and continuing to accelerate, the Fed is expected to lift interest rates by a half percentage point at the end of its next meeting on Wednesday. It will be the second of 7 planned rate hikes in 2022, following a quarter-point increase in March as the Fed tries to cool consumer demand and slow rising prices. Central bankers and most economists say the Federal Reserve can bring inflation back near its 2% target from current levels. Consumer prices rose 8.5% year-over-year in March without killing economic growth. The Fed's own economic forecasts reflect that expectation, and a recent poll conducted by the Wall Street Journal shows that just 28% of economists said they see recession over the next year. By raising interest rates, the central bank is hoping to achieve a proverbial soft landing for the U.S. economy, in which it's able to tame rapid inflation without causing unemployment to rise or triggering a recession. The Fed and professional forecasters project that inflation will recede to below 3% and unemployment will remain under 4% in 2023. The current consensus view that a so-called soft landing is not only possible but likely is reminiscent of the former dominant view that inflation was transitory. Now the new macro narrative is based on the assumption that inflation has peaked. But as inflation sits at a 40-year high and feels worse than the headlines look to many businesses and consumers, given how fast food, energy, and shelter prices are running, war in Ukraine and COVID lockdowns in China mean that the peak inflation argument is even more fraught than it already would be, based on domestic shelter prices alone. It seems there are two realistic scenarios for how the coming months play out. Both end with recession. Either the Fed sufficiently fights inflation or it doesn't, the latter resulting in the stagflationary combination of high prices and slow growth that inevitably leads to a worse recession. Welcome back to Savvy Finance. Before we listen to Raoul Pal, please take a second and hit the like button and subscribe if you are yet to do so. Thanks for your support.
There is a massive liquidation going on as people struggle with their portfolios because basically whatever position you've got, it's wrong. and that's the pain everyone's going to have to take for a while.
Where are we right now?
So I think we're at an inflection point, and a lot of people don't agree with me. So I wanted to go, that's why I did the campaign. It's like, listen, this is a really complicated macro environment, but it's very macro, right? We need to know and understand from the best people in the world what the hell is going on, because my voice is just my voice. My personal view is that we are doing the transition from inflation to growth. The next shoe to drop will be the inflation shoe. I think inflation and growth go lower, and we either head into recession. Europe looks like it's already in recession. China has been essentially in recession for a while now, but maybe coming out the other side, early stage. And the US forward-looking indicators suggest, look, it's not clear it's a recession, but it's clear that the ISM is certainly headed to 50 or maybe just below, which is the ISM, the Institute of Supply Management Survey. Anything below 50 suggests that growth has stalled. Anything below 47 usually gives a recession. So we're getting in the phase where we're going to have a very slow patch, and there is no sign yet that that's turning around. So it could accelerate lower. So the recession is potentially on the cards. It's certainly on the cards in Europe. And we need to figure out, what does this even mean? What does it mean? And I think the big thing it means is bond yields are coming lower, because the inflation narrative, I think, is about to change. In the content, week 2 of the content campaign, we have interviewed, I'm so lucky to be in the position I'm in, to be able to sit down with, ask Pierre Andran, the world's best oil trader, what's going on in the oil markets, and Dwight Anderson, probably the world's most famous commodity trader, what's going on in the commodity markets. And, their view is these kind of prices will lead to demand destruction. And I think that's what we're seeing. We're seeing commodities crowding out growth.
Raoul Pal also stated that he is also keeping an eye on crude oil to see how it trades because a lot of people has a very bullish forecast. But he stated that he is worried that the demand situation is not quite as good. And if crude oil does break the pattern to the downside, then the inflation narrative would disappear very quickly, because inflation expectations are basically driven by the oil price bizarrely, as if that's not the only thing that drives inflation. But that's what drives inflation expectations that will change the narrative a lot and drive the panic into bonds. If you've got a falling equity market, falling growth, falling inflation, well, that drives everybody into the dollar and bonds.
Oil either needs to break above 110, which it tried to do, and maybe even a bit higher than that, or if it breaks below 95, then I think it accelerates lower. So we're in a tight range. It's kind of, tenterhooks, which way it goes. If oil breaks higher, it's only going to increase the demand destruction and the squeeze on corporate balance sheets and the squeeze on households. So it's not a good setup here either way. We've either done the damage already or we're going to do some more damage. So these are very important markets, and this is a very macro environment, and it's very, very important to understand what it is. Yeah. Now, if I'm right and that the inflation story is going to change and growth is going to go slower, then we start shifting into a dynamic where we question what the central banks are going to be doing, and if bond yields are going to come lower, stuff that's been really beaten up, like the further end of the growthy stocks, they should be more interesting in that environment because they got killed by inflation. I think gold does pretty well. It's, interesting enough, gold and growth stocks tend to do badly as real rates start tightening, but they got to zero and it looks like the world's falling apart, just as the central bank are trying to undertake quantitative tightening or at least no QE. And if that's the case, then real rates are going negative again, if I'm right. And that's usually good for gold, crypto, long end of growth, that kind of stuff, and bad for everything that people have been in, like commodity stocks. The real economy seems to have slowed really fast. So, because what's happened is everybody built inventories because of supply backlogs, right? The right thing to do. Supply backlogs clear, demand falls because of high commodity prices and inflation. Everyone's stuck with a whole bunch of inventories that need to be liquidated.
Yeah.
That's not good. And we're seeing the supply backlogs clear because, the Port of Long Beach in the US, much clearer now. We're seeing the same with freight traffic has gone negative year on year, suggesting that the economy may slow significantly forward. So those kind of indicators, restaurants been weak. The consumer has offset some of this by credit. So we've seen them drawing down their savings. So the savings ratio has been collapsing. But consumer credit has held up. And that's what traditionally happens in the US. They balance off savings and credit. But if people start losing jobs, then all bets are off. Again, I don't think there's anything really severe on the horizon, but let's keep an eye on it. Europe, different story here. Europe's between a rock and a hard place because of the reliance on Russian commodities, particularly on gas. And Europe's in the transition to ESG. That transition is going to take the best part of a decade before it really starts taking marginal demand away from fossil fuels. And they're steadfastly wanting to adhere to that, and I think it's the right thing to do, but they're going to have to take pain in the middle, and the pain is the economy. And what's happening is the outlet valve for that right now is the euro, which has been going down fast. We've seen the outlet valve in Japan being the yen going down fast, and we're starting to see the outlet valve in China being the RMB going down. Now, that's actually good. The rising dollar is bad in the short term because it creates funding problems and it can slow growth significantly. But if these economies see cheaper currencies over time, it's going to create a larger deflationary wave because they're all exporting nations. So there's kind of the bad of the strong dollar and the good of the strong dollar all at play, but that's a phased thing. First, the dollar up fast is a bad thing. Then a weak set of global currencies helps them get traction and recover.
According to MarketWatch, to bring down surging inflation, the Fed will try to raise interest rates more to curb consumer demand. The resulting increase in borrowing costs can help slow economic activity by discouraging consumers and businesses from making new investments. But it would come at the risk of causing major economic disruptions and pushing the economy into a recession. This is the soft landing. Interest rates rise and demand falls enough to lower inflation, but the economy keeps growing. The U.S. economy today is facing additional inflationary pressures from higher grain and energy prices due to the Ukraine war and more supply chain disruptions as COVID-19 forces new lockdowns in China. These factors threaten to exacerbate inflation even more over the coming year. According to MarketWatch, the inflation problem facing the Fed today is substantial and unlikely to be resolved without a significant economic slowdown. Overall, the combination of an overheating economy, surging wages, policy delay by the Fed, and recent supply shocks means that a recession in the next couple of years is certainly more likely than not. Right now, with the gloomy economic outlook from many experts, it's difficult to decide what assets to invest on because even crypto looks like they will be in the red for some time. As Raoul Pal stated, whatever is your portfolio, you are bound to experience some negative downturn in the short term. Here at Savvy Finance, we believe Bitcoin still remains the best edge against inflation, and we will keep investing in it even if we officially enter a recession. What do you think is the best asset to hold right now? Or do you think holding cash is the king right now? Let us know your opinion in the comments section. Thanks for watching.